This is the MBK Beat with Mark Kashevsky from MBK and Associates, Inc. Your place for finding all you need to know about life insurance and how you can get more out of your money. Recorded live here in Buffalo, New York, it's time for the MBK Beat with Mark Kashevsky. Hey folks, how we doing today? We are here live with Mark Kashevsky. And this is episode 3 of the MBK Beat, where we talk all things life insurance here in Western New York and just try to provide value to your portfolio. So, Mark, I figured today we'll get right into it. I know you wanted to talk about long-term care insurance specifically today. So I guess we'll just get right into it. And what is long-term care insurance and why should we be talking about it today?
Well, long-term care insurance is often described as disability income for seniors. And it's really a health insurance product that's designed to provide funds for senior long-term care issues, home care, nursing homes, assisted living, etc., which people are pretty familiar with the fact that those costs are significant. You know, $10,000, $15,000 a month if you're in a long-term care facility. And they can literally bankrupt an estate or a family. And people who are approaching retirement, this becomes, a concern. How am I going to fund that potential risk, that health risk, that has a significant cost to it, and protect my personal and estate assets for my spouse and my family? So that's the genesis of why this developed 10, 15 years ago.
So this is actually, I was just thinking that this, as opposed to maybe some of the other life insurance policies, is actually probably more of a new thing with more people going into these facilities and that becoming more socially normalized.
Yeah, it's in this generation, the last 20 years is when it's really become an issue both socially, politically, economically, insurance-wise. And there's been, an evolution of how to deal with it. You have first-generation products that were designed to cover the cost, literally, of nursing home costs and benefits. They were designed by a variety of insurance carriers. At the time, many of them had a fixed premium, and those are no longer available. And as time evolved, legislatures got involved because people were moving assets, doing estate planning to protect assets so that Medicaid would cover, ultimately cover the individual in a nursing home once, or a Medicare, I should say, once they reached a certain point and had no assets. And that was starting to become a huge cost issue for both the federal and state governments. New York State, for example, passed legislation limiting what you could do to transfer assets within a certain time period in anticipation of needing this type of coverage or care, long-term care. They also developed a partnership plan for New York residents, where if you were to provide this coverage for yourself and had to use it, income and or assets would be protected. I believe at this point, assets are protected. Not income can be used. Retirement income like Social Security still can be utilized for it to help pay for these long-term care expenses. But having said that, over time, as more and more people started utilizing these various coverages, insurance carriers realized that they had underestimated both the utilization rate and the cost because they both gone up dramatically. So you had a lot of carriers who stopped issuing guaranteed premium contracts, stopped issuing contracts altogether, and existing contracts. And I had a contract myself for 4 or 5 years that every year I owned the contract, the premium started going up. And I'm saying I may not need this coverage, if at all, for 20 years. What's it going to look like in 20 years? And I've seen this happen to customers, clients of mine, where premiums kept going up, and they had to make decisions to keep the coverage, to drop it, to change the benefits, and so it's led to additional evolution in the marketplace from an insurance standpoint.
Some of the things that I saw in a little bit of just some of the preliminary research was hybrid policies where potential for, maybe a beneficiary to receive a death benefit if you don't end up in long-term care. Is that something you've seen maybe encounter to less insurers providing these? Is that sort of where that has gone, is to maybe change it up a little bit to some of those hybrids?
The evolution of this product is gone from a standalone product, which is still available and people still buy it.
Would that be the more traditional?
That's the traditional long-term care policies, to hybrid policies where they're basically taking a long-term care policy and combining it or stuffing it into a life insurance contract. And what that does is provide some premium stability, so you know what the premium is going to be long-term. And I'll explain that in a minute, why that is so. But additionally, the fact that if you don't use the benefit for long-term care coverage, there's going to be a benefit paid to a beneficiary or a cash value that you can recover on your own if you want to get, stop the coverage. So there's the ability to get, there are three ways to get paid on this contract, either through a long-term care a claim, a death claim, or a recovery of premiums and or interest. So, or cash values. There are different contracts that do it differently. So, myself, I'll use it as an example. After about 4 or 5 years of having a traditional policy for my wife and I, which we were paying through our corporation, getting a tax deduction for it, it was done as my wife's insistence. I said, honey, this thing keeps going up. We're never going to be able to afford this. And there's a different way to solve this problem. So I took the premiums we were paying at the time, which I believe were between $300 and $400 a month each. And I said, we're going to take whatever these premiums are now, see how much life insurance we can buy with this premium, permanent life insurance with a fixed premium, and whatever that buys as a benefit, that's what we're going to pay for. So it turned out, I believe we ended up with about $450,000 of life insurance coverage each. The long-term care rider was a 2% distribution rider, which means $9,000 a month, which will probably pay us for between 4 and 5 years.
So that 2%, that would be a percent of total cost?
Well, the way that the carrier I utilized said the long-term care benefit will be paid out if you qualify, which is the same qualification for a traditional long-term care policy. You will get 2% of your death benefit a month until it's gone.
Okay, so 2% of that death benefit would be allotted to long-term care.
Right.
So that would be sort of one of these hybrid?
Yeah, that's a typical hybrid approach.
Okay.
And it has the same definitions of disability, how you qualify. They have these activities of daily living definitions in all these contracts, whether they're hybrid or standalone. And if you can't perform 2 of the 5, you're, under care of some kind, you will get a benefit. Some of these contracts reimburse for payments. Others just are cash indemnity payments. They just pay you once you qualify, and you get the money up front. So, and they can be traditional or hybrid. But so we have a situation now where I'm putting money in every month, premiums, and it's building up some cash, but that's not why I'm doing it. But there is cash in the policies. And in the event we need to use it, I can collect up to $9,000 a month, each one of us, for a period of time. Now, will that cover a long-term care stay? Probably not. Long-term care costs are between $10,000 and $15,000 a month now in an actual long-term care facility. But we've set up our home. We have a patio home now. We're on 1 floor. We can bring healthcare aides in. We can live there for a long period of time. So, we designed this so if we need to bring someone in for those types of services, that'll probably that benefit could last 5 or 10 years, because it doesn't cost maybe $9,000 a month, and if it does, we've got that money. Or if it's over, then it's less of a hit on my personal assets. But I've got a fixed cost, I've got a benefit, and I've got if neither one of us uses it, we've got something going to our kids.
And then they get the tradition, almost more traditional beneficiary life insurance standard benefit that I think most people think. And that, I think, is one thing that why we're doing this podcast is really just to open up the viewer's eyes to the options and creative strategies that they might have never even thought of, because traditionally everyone thinks just death benefit to the kids or to the wife or who gets the will. Why would someone want to start looking at this, and when like around what age would someone want to start thinking about this?
Well, typically I have people in their 50s and certainly in their 60s that this percolates up to the front of the line in terms of their consciousness.
Right.
But that's a very good question. I said the situation I see couples. They have life insurance portfolios. They've had to save money, to pay for tuitions, to pay off debt, to replace family income if one of the spouses dies. It's traditional reasons for buying life insurance. And now all that's happened. And they say, okay, what do I want to do with this life? Why do I want to keep this life insurance? And oh, by the way, do I have to buy another policy here? This is a whole separate issue, long-term care. And my approach to people is when I'm doing, as you know, I like to do a lot of policy audits for people getting ready, within 5 to 10 years of retirement, saying, you know what, you may want to rethink what you're doing here and reposition your existing life insurance that you've already been paying for and do as they call it, 1035 exchange, and repurpose this insurance to address this issue. And oh, by the way, if you have existing life insurance with cash values in it, those are going to help reduce the cost going forward to provide this type of life insurance with a long-term care benefit. So I do a lot of, restructuring of existing insurance to buy one of these hybrid policies with a long-term care rider in it. And as opposed to just starting fresh, you're just taking what you've already paid into, repurposing it and reducing the cost that you otherwise would have to pay to get one of these policies.
So would it actually benefit if somebody has been paying on one of these for years and they don't even really know? It actually helps potential new, as far as like their cost on the next policy or any adjustment policy. Would it be fair to say that them paying over time actually helps that cost? Or
well, yeah, if they have prior credits, so to speak, from a prior policy, you're basically rolling that cash into this new contract, and it's going to offset.
You don't lose it, essentially. You're not losing anything by making an adjustment.
No, you don't lose any cash. You just have to be insurable. And assuming that's the case, yeah, you're basically restructuring something that outlived its useful life, so to speak, to continue to provide value, but because you paid into it for so many years prior to this, the new contract's going to be less to solve this long-term care problem than it otherwise would, and you don't lose any of the cash you roll over.
Right. I think that might be a misconception amongst the person who may not know of all of these details, is just, well, if I had agent X at company X, they may think that it's not their money, that this person, whereas
it's their money.
It's their money. It doesn't matter who you're working with at this company. It is your money that you've been paying on. They just happen to have it right now.
Yeah, well, and some carriers like to hold on to that money, but the reality is it's your money. And so, the old set it and forget it deal, or get rid of it when I'm done with this. That's a whole. The marketplace and the product options, as we've talked about before, are so myriad and diverse now, like what we're talking about now, with these new hybrid products. You really, you need to kind of look at what you have and see what's the best way forward, given where the issues I want to address. So that's one approach. That's why people are looking at hybrid policies, and why you can repurpose existing insurance. But I do want to point out two other things two other scenarios I run into. One of them is, and I've been looking at a case right now. Someone's got an existing long-term care policy, a physician. They want to know, Mark, what should I do with this? I said, well, I don't know. Let me take a look at it. I don't know. She may have had this forever. It may have a fixed premium. If she does, it's liquid gold. I'd keep it because it was probably very inexpensive, and they can't change the rules.
Because they can't turn up that dial on her at any time.
No. So, I haven't seen the policy yet, but so you run into those situations, or one like my wife and I where, right from the get-go, they were raising premiums. And I said, wait a minute. After 4 or 5 of these, you say, what?
Yeah.
Yeah, 20
what's
years.
Going on
what's
here?
going on here? So you have people with existing coverage, traditional long-term care coverage, you may want to look at relative to what I just expounded on. And then for higher net worth people, they take a different view of this, saying, listen, how about if I want to protect my assets? I mean, I probably have enough money to maybe take care of this with my own assets. And my approach to them is this. I said, if we could just move the deck chairs on the Titanic, so to speak, go from the left to the right hand without sacrificing any of your liquidity, but in the process of doing that, provide a benefit so you wouldn't have to spend your assets down, would that make some sense?
Right.
And that makes a lot of sense to people who have money. And what you have now is you have another type of a hybrid product. It's a single premium product, okay, a variety of very good carriers have, where if you take a lump sum of money, whether it's $100,000, $200,000, $500,000, $1 million, you move it from your bank account, okay, you move it over to this insurance policy, and it's completely liquid. Or in some cases completely liquid, in some cases 70 to 80% liquid.
Meaning you can
take it out the next day.
Right.
But and that money's always going to be there, okay? Either if it doesn't have 100% liquidity from day one, eventually it will. So you're going to have you're going to have that cash is always going to be available to you from a cash or investment standpoint or liquidity standpoint. But in lieu of paying you interest on that money, you're going to get immediately a long-term care benefit that increases over time. And if you need it, you'll get to use the long-term care benefit, all right? And if you don't use up all your assets, you'll get that money back. Your kids will. If you do use it up, then it'll continue on. Or if you don't use it, that money's going to be paid to somebody that you invested in this contract. So it's more of it's a different strategy than what I've said before, but it's just basically moving assets, foregoing earnings on those assets to get a benefit, and if you don't use the benefit, your liquidity comes back to your state.
Yeah, and essentially, if someone did have that type of money, higher income people, it might just think, if it happens, I got to go, whatever. We've got enough money in this estate, but it may seem that way to someone with that money, but to someone that doesn't have that money, it would be a no-brainer, considering, these you could probably squeeze that $100,000 that might come out of pocket for long-term care, or having someone come to the house to take care of you when your kids are older. Where could that money go that might serve your family better?
Well, exactly. When you look at the numbers, and I don't want to get too into detail, but if someone takes a couple $100,000 or $500,000 and moves it over here, they're getting multiple dollars of benefits. $500,000 gets you $2 million or $2.5 million of long-term care coverage. So it's not a dollar for dollar trade-off.
Right.
So for putting that money over here, still having liquidity, you're shifting a significant.
It's almost a multiplier of what it could go to home health care or long-term care.
It's kind of like, do you want to self-insure your car insurance or not? Well, people with assets have high deductibles, $500, $1,000, maybe $5,000. This is the same thing, okay? Because that portion of, if you do use it, a portion of that cash is going to be or all of it used up. But if you go beyond that deductible, so to speak, okay, you've got multiples of benefit if you need it. So for people, people who typically with assets that, here's a way to keep liquidity, basically have a high deductible, but, if you go beyond the money you've segregated for this, you're going to have a lot more benefit. And the logic, it's the same logic as, why people who have significant liquidity, use high deductibles on other types of personal coverage.
Yeah, things are starting to make sense to even me as a novice here. So I think
good. Then I'm doing a good job.
Yeah, this is
Hopefully.
I think this is been very successful, and I think again just to sort of restate why we're doing this is it's hard to put on a website or put on a piece of paper all of these things, and the best thing to do would be talk to an agent. But even specifically in my research, an article from AARP, former editor of Money Magazine, says, as for where to shop, who to go to, seek out an independent agent who sells policies from multiple companies rather than a single insurer. And I thought that was pretty spot on with what we're talking about here.
Yeah, that's there's more than one carrier out there, both in the hybrid. In the standalone, there's only a few left, by the way. But in the hybrid market, there's several carriers, and also in these single premium asset transfer strategies, you've got some very good carriers out there that have some very good products, and they're all fairly similar. But yeah, pricing's fairly similar. The issue is, different carriers. Some people are better at underwriting the risk than others in terms of your health, in terms of ratings, because that factors into the ultimate cost. It's not just, here's what the price is for this, what classification do you fit in for the life insurance and the long-term care. And by the way, one other comment I want to make from an underwriting standpoint is, how can you stabilize the premium in a life insurance contract as opposed to a standalone contract when you still have the same risk? Well, when you stuff a life insurance, a long-term care benefit into a life insurance contract, the underwriters ultimately underwriting your mortality.
And they dictate sort of what...
Yeah, that dictates what the price is going to be, okay? It's because, and by the way, actuaries are very good in insurance companies, because they've been doing it for over 100 years, being able to predict mortality. Much better than morbidity. In other words, what's your chance of using this for long-term care? The only difference with, when you put a long-term care contract in, and when they have to look at morbidity, it's really just a discounting. How much do we have to discount the cash in the policy to provide this? Or how much do we have to add some additional cost to provide this given any health issues? So it's, they're tinkering at the margins from a pricing standpoint when the main objective is to price the mortality as opposed to the morbidity. So it becomes much more predictable. And that's why you're seeing essentially the whole marketplace gravitating to this approach.
And does that morbidity, mortality, with regards to age, is that why someone may be better off getting into something like this earlier in life?
Yeah, that's a good point. That's a good point, Greg. Before age 60, it's less of an issue in terms of looking at cognitive issues. Once you get above 60, they take a much closer look at that. So that's but then again, you still have to be able to put your shoes on and
walk and chew gum at the same time.
Exactly, and what have you. But things get a little more involved after age 60.
Is there anything that people should know as far as, once again, I've got, maybe an existing policy, but is there any reason why someone shouldn't look into something like this, or maybe something else? Why is there anything that would maybe just sort of this wouldn't fit for someone out there that maybe this wouldn't fit for, or is this just?
Well, anybody who's between 50 and 60 who's thinking, what do I need to, what should I be doing with my insurance? Or I'm starting to do, pre-retirement planning. And anybody who's doing, trying to get their ducks in a row for retirement, it's not just about insurance and about investments and, where you're going to live. It's also, what about my long-term care issues?
Mm-hmm. Especially right now with obvious health being probably very, a primary concern for a lot of people around the world.
Right. That you bring up a good point with the COVID situation right now. That insurance carriers are writing people either up to age 65 now, or 70. It depends on the carriers, but some carriers are saying if you're above 65 or 70, we'll underwrite you, but we're not going to issue the policy until this COVID epidemic is over.
So that's
That's a very good point.
That's interesting.
If I can make one comment relative to my website.
Yeah.
I do. You've put up on my planning ideas in these long-term care planning strategies, both the hybrid and the single premium strategies. I think I've got some information and examples up on my website if people want to look there.
Yeah, that's at mbkinc.co. So mbkinc.co. You can find a lot of information on there. Phone number, where can they reach you if they want to give you a call?
Office is 716-855-1600. That's my office number, not my cell. And our email is, my email is mbk@mbkinc.co. But that's where you can reach us, or you can go through our website and connect with us there. And like I said, there's some information and examples on this whole issue on my website.
So that's long-term care. I think we'll put a wrap on episode 3, and we will see you folks in a few weeks, where we'll be talking a little bit more about life insurance and what you could be doing here in Western New York. So thanks, Mark. I appreciate your time today. I'm learning a lot here.
Great, good. We'll get your license soon.
Yeah, there we go.
Take care. Happy holidays.
Thank you, Mark.